was also thinking like if I get enough write-offs or enough K1s with negative or
Absolutely. It's one thing may generate income, the IRS, but then we get another thing to offset it. So we get to defer. And it's, there's good deductions, there's bad deductions, sometimes some tax will charge at a higher rate. It makes it kind of crazy. Einstein talked about theory of relativity is easy as the income tax code that was hard. And now, much like it says here, income taxes are still less than 100% for now. But we just kind of want to make sure, hey, what you're doing is smart. And no matter what you end up doing with taxes, just kind of make sure that you got a good plan in place.
yeah. Thank you. And we're gonna get in more to that. So massive value add. So we're gonna go over our agenda a bit about massive value add, and then the tax and legal structures in a Q&A tonight. So Trevor, you want to pick up from here?
Absolutely. So this is a little bit about Massive Capital itself. Massive Capital is a vertically integrated real estate company specialized in ground-up construction, retail, flex space, industrial, self-storage, and mixed-use multifamily. It's an owner-operated for value-add multifamily assets, where our sister company is Realty One that has 40 years of experience. Massive Capital itself has 200 years, and somehow that comes to 100 years combined. It's because there's lots of people involved, and we've been doing real estate for quite a while. So on the left-hand side, you'll see that Massive Capital is involved in equity, brokerage. Brokerage is on the triple net assets, which is retail, not on multifamily, and property and industrial, those types of things. Also property management for retail and triple net leases. We do development, we do construction of metal and wood, and then we have our awesome education mastermind program that we'll talk a little bit about later on. As you can see, we're very focused in Texas because we're all based in Texas, but we do have assets in Denver, Colorado, North Carolina, and Atlanta, Georgia. We have been looking for retail opportunities in Phoenix and Tampa, but to date, we haven't been able to get anything secured there. Realty One itself has about 500,000 square feet of retail space, 252 on a retail center. Their total assets is 290 million. And then on the Massive Capital front, we actually just passed, we're very close to 200 million. We need to add that we closed our Horizon asset. It happens when you close quickly. And so right now we have about 1,500 multifamily apartments. We are building the X space. And so it's super amazing that between the two companies, we are very close to $500 million in assets. Super excited about that.
Awesome. Thanks, Trevor. Here we go.
So here's the team behind the team. So a lot of these folks, some of these folks you will deal with and you won't deal with on a regular basis. Across the top, there's myself, Jasmine, Maria, Candice, Aska, Brenda, and Jonathan. Those are ones that you might deal with more on a regular basis. Then we get more into our financial and our acquisitions team. It was super cool. Bhaskar was just here from India. And he'd actually been working with Shirar for 6 years and they never met. So it was awesome. And then Aska also came over from Pakistan. So it was super nice to meet some of the team. And then we get into a lot of the Realty One folks that are finance, they're construction managers. And then Ramesh here on our acquisitions. He's actually more now on our systems and our CRM, which is super powerful. So you can see we're definitely building a very good team here. And we've actually even had a couple of additions for our education and mentoring program and things that we're doing. So we're super excited about that. We'll pop to the next slide and see our fearless leaders.
Yeah, I was gonna poke in here a little bit, Trevor, because I think we swapped out slides here. But yeah, Ramiz is actually part of our. It's not out there that much, but our massive technologies division that we have recently created. And then Rimsha is not on here. Rimsha joined us a couple weeks ago. A lot of you may have met her. She ran our first virtual event from the background and got it. Our third virtual event, not our first, but her first with us. And she ran all that from the background. She's running our education and events coordination.
Yeah,
There
and
you
for
go,
those of
Trevor.
you that don't know our virtual conference, she was given about 3 days notice. I think she worked 3 20-hour days and pulled off an amazing event. For those of you that joined us, I hope you agree.
Go ahead, Trevor.
So we have Shirar, Sanjay, and Mike that are part of the Massive Capital team, and then Bo, Pat, and Alexis that are part of the Realty One team. Together, we work together to do massive things. So we do have one opportunity still left in San Antonio. For those of you that know, we have two. Yes, that's correct. We have another one. So this one is our multifamily opportunity. And in fact, our team is there today. They have today and tomorrow, they have meetings with all of the contractors, property management company. We took over that asset. It's 204 doors. It's doing amazing. It's in a great location in San Antonio. We still have some room left for people to invest. So we'll put a little link in the chat where you can book a call with us. But it is a super, super fantastic. We're estimating, I should say, instead of offering, it's a 2.11 multiple of your money. So again, if you put in $100,000 in 5 years, you'll make more than an additional $100,000, a projected 18% IRR. And one of the things that a lot of people want to make sure you understand is there's a 7% preferred payment. So what this means is that investors get paid the first 7% of the cash flow based on their investment before the general partner sponsorship team gets any payment. This is a real investor first. And then at the end, we split the proceeds 70-30 on this particular deal. So super excited. We did close 15 properties since then, and we have several opportunities pending.
And then, so this QR code here for this and any other deals just gets you into the system. Scan it. Really, it's not a you're get into the portal. It lets you see the deals. Take a look at what we've done, what deals we're doing, but it's no commitment to buy, nothing to purchase, no risk to scan the QR code, sign up, and just take a look inside of what is being offered. Trevor, go ahead.
So this is an exciting opportunity that we had in Austin, Texas. We were oversubscribed, but as in any business situation, sometimes something happens. So we actually had an investor. It was a 1031 exchange. Those are super complicated for coming into a deal. We've done them all the time, but the investor themselves wasn't quite aware of all the complications. So they decided to withdraw from this investment. And so this now creates a great opportunity for people. So this one here has an estimated 20% return on your investment. It is a 75K minimum. It's a 1.72 multiple of your money in 3 years. It also has a 7% preferred return. And these numbers are based on a 50-50 split. But in case we don't hit the over 17 IRR, it would be a 70-30 split. So this is 16,800 square feet of retail development, literally 20 minutes from my house, just north of I-35. It's an amazing, it's on a road called Harris Ridge, and it's an amazing opportunity. So reach out again to our team. I'll be happy to talk to you more about this development. And this is our first deal with our partners, Realty One.
It's actually, Trevor, it is actually our third, and it's the first we started on this one first, and then we actually did another couple deals in the meantime that had a little different relationship on those that we did. And so this is actually this becomes our third overall deal. It was our first one. but it's overall our third. One of the things I would say on this one, if you are, interested, because we do have, because of the 1031, tenants in common, the TIC as it's called, fell out. We do have a fairly large opportunity available. So if anybody's interested in investing over 250,000, we have an opportunity for an extra 10% bonus on what you're doing. So take a look at that as well. If you or if you know somebody that wants to make a large investment, get that return faster and get some bonus on it.
All right.
Thank you. So thanks a lot, Trevor. Appreciate the lead ins there for us. Get us going today. Again, if you're interested in that, get a hold of me, Trevor, or anyone on the team, especially for the large investment that somebody wants to come in with. Let us know. We can work that out and make a great opportunity for somebody. The massive value add tonight, group learning by actually doing as well. So continued. We have the massive mastermind, and a lot more of that'll come. We'll share the link here, but if you go to multifamily.education, you'll find us, find the massive mastermind there. You can guess who's in it, and we got a lot of secrets behind the curtains there to share. But deal flow and everything else is one of the keys to our longevity there. A private, highly vetted community for business owners is what we are. We're looking for those that are really real estate investors, people that are corporate employees, people that want to be full-time, that want to become a general partner and be serious, be able to be reps, right? And Bill can even share more on how valuable that rep status can be, right? We want to get people to a rep status, get that tax to zero, and get your income to zero theoretically. How do we grow together as a team? We do it by JV on land. We love the JV. If you guys have land, if you know somebody that has land, send it to deals@massive.capital. We'll do everything in the deal. We'll get all the documents done. We'll get the debt. We'll do the construction and take care of it. We can, as well, evaluate and assist on any assets that are under construction and help look at bringing that to the finish line. On the multifamily, we have an asset management process and tools that we bring on top of every property management that's out there. So if you think of any property management software that you've seen or run, we bring an asset management tool on top of those, run it like a portfolio. You see the dashboard, everything together, lets you be a financial manager of the assets, and it lets you go tell the property management company ahead of time, like, what's going on, what are you guys doing, versus waiting for them a month later to see their monthly report. The CapEx, we can do that, take over any of your projects and complete any projects from CapEx, large CapEx to medium CapEx, with the in-house construction team. And that can include like taking over a project that got stopped in the middle. We've looked at a few of those, some projects that got started building, didn't get complete. We're looking at them, taking them over from those or from the banks that may own them now. Credit enhancement, basically meaning helping on the balance sheet to do or close a deal, and as well the experience. So the experience is as important as the balance sheet. So you could have a huge balance sheet and still not be able to get a commercial real estate loan potentially, because you don't have the right experience for the right size, the right type of assets that you're looking to take over. And then our last piece, the big is our consulting services. So come and sign up. If you don't have a CRM, check it out. the MMS.capital. Get a CRM, includes the website with it, the CRM and some automations built in with templates that follow what we've been doing and how we built out our process. We've built, we're adding over, I don't know, 20 to 30 people a day still into ours through the funnels that you create in the CRM. So you get to work with us, see how we've done it, implement yours the same way. And as I mentioned, the asset management as well for larger operators. So we can implement the same process I talked about over here. We can implement that for larger operators on their multi-portfolio type of projects. So, alrighty, so let's jump in to the good stuff, the tax and legal while y'all are here tonight, understanding K1s, the work process, and the legal structures. I think I may have these back to forwards on the way the slides go. Bill, you're going to talk about, I think, the structures first a bit, and then we'll jump into the K1s. Bill, you want to introduce yourself again real quick before you, I mean, go ahead and you start and we'll go through the slides here together and introduce yourself.
Yeah, hey, thanks, Mike. Hey, good to see y'all tonight. So I'm Bill Pilkington, tax CPA here in the Texas area, a little bit north of Houston. Most of what we end up doing is revolving around real estate, but I've been doing this like 30 years, so I've seen a thing or two. What we're kind of hoping to do tonight is give you a good idea, like, so as you invest in some of these things, because I get a lot of questions. Hey, should I put this in an LLC? Do I need to be a corporation? What's better? How am I going to pay tax? I have an IRA, 401k. It's just kind of like sometimes just getting started, people are wondering, how do I buy into this? Then right around this time of year, some of y'all, if you're already in deals, you're probably starting to see the K1 start coming through. And we're going to talk a little about those of like, so after you've been in the deal, now what? I got this thing here and I probably need to do something with it on my taxes. And finally, something huge again, so that a lot of people investing with an IRA, it's an awesome way to invest. It just comes with a few little things that are different that a lot of people don't know about. We've got a lot of IRA investors. Again, it's a great way to do it. We've got some great custodians here, and there's a change that happened in 2023 that we're going to go over. So one thing that we look at, so we talk about individual Social Security number. You'll also sometimes hear that called like a cash investment. Cash doesn't necessarily mean like, $100 bills. That's just, you can put on a charge card, you can, write a check, do wire transfer. But what it really means is that you're not using any type of business asset. You're not using any type of retirement funds. You're using your own money, and it's individual SSN or Social Security number. That could include if you have a joint account, like a husband and a wife, or a married couple. But it will go to the first person listed, could be either one of the spouses. And the real reason for that, the K1s, which we'll talk about, meaning the IRS only has a way of recording one person on the investment. So if you are a couple and you each want to get in and you want your name on it, you're going to need to invest twice to get two separate K1s. But if you're filing a joint return, generally speaking, putting it in one is going to be okay. Just you list it who's there. And so that allows you then to directly invest in it. Typically using after-tax money is one of the most tax-advantaged ways. Got a lot of benefits as far as cash flow to you. A lot of benefits also about with estate planning. 1 out of every 1 people dies. So it does make it easier sometimes to pass it on to the next generation. Big thing you always want to be concerned about is, so if you're investing just in direct real estate, what type of debts are you looking at? What type of potential lawsuits? Nice thing that happens normally when you're investing in a syndication, if you're going to keep below 20%, like, so you're going to own 20% or less of the actual asset, generally speaking, there's not a lot of liabilities that come with it. It's the LLC itself or the limited partnership itself that is carrying the liability. And so you're generally getting shielded from anything based on that. And then as all of you are individuals, you're probably filing your own personal taxes. You know, we're talking about US residents. Doesn't have to be a US citizen, but what I'm talking about here is for people that file taxes in the USA. And so what you're going to be doing there is then reporting any income or losses on your personal return. And this money, again, it'd come from your savings accounts. It's your money that you've already paid your Social Security tax, your sales tax, your income tax. You know, after 5 different government agencies already dipped their hands into your pocket, it's the money that you have left over. The next one is what we call like an LLC, and that stands for limited liability company. I get a lot of people that, you know, they do say limited liability corporation, so it's okay, I know what you mean, but it's actually limited liability company. Now the funny thing is, LLCs just in and of itself really doesn't mean anything to the IRS. It means something when you do it at the state level. So each of y'all in any of your states, or you know, or in Washington D.C., this is the way to form a business, and it protects you from a lot of your liability. Now, how the LLC pays tax, it can actually pay in any way imaginable. Whatever you think of a way you can pay tax, the LLC can do it. So to the IRS, you have to tell them how you want your LLC to be taxed. And if you choose not to decide, you still make a choice. Because what that means is if you do nothing as an individual, you're going to report the income and losses from the LLC on your individual tax. It's what they call a disregarded entity. Same thing as if you never had one to begin with. If you form your LLC with 2 or more people that are not married, it's going to default to a partnership. Now, you might, in certain circumstances, maybe it's more beneficial, your same LLC, same name of the company, same tax ID number, might be taxed as an S corporation, might be taxed as a C corporation, might even be your IRA might be owned by an LLC. All those can change. Typically speaking, in real estate deals, we see the LLCs as being disregarded and or partnerships, because those tend to be the easiest way to pass out any of the cash to the individual members. Now, there are benefits to them, but one of the things, they're not free. Short of actually in Texas, actually, if you want to form your own LLC and you are a veteran, Texas has made it possible where you can form your LLC and not pay the fee. That being said, unless you absolutely know what you're doing, I don't recommend it. I didn't even form my own LLC. I hired an attorney because you don't need the paperwork to be done right until you need it to be done right. And by that time, it's too late. So I always recommend getting with a good attorney to help you form your LLC. Not required, but it's something you may want to consider. And then as you form your LLC, there are just, even if you do it as disregarded, there's always some type of filing requirement at your state level. So just make sure you're kind of doing everything that you need to do there to keep all your paperwork in order. Next one is with your IRA. So now, while we mention Roth IRA, sometimes they can use pre-tax IRA. Roth IRAs are a wonderful investment vehicle. I actually recommend all my clients. It doesn't matter. Well, you have to have some income, but what I mean by is if you have any type of earned income and you have the ability to set up an IRA, create one. Even if you make $50 million a year, you can still set up a Roth IRA. Highly recommend you get it, even if you only have your $1,000 in it, because the thing is, the IRA, you never know when you're going to need it. And so Roth IRAs often come with a 5-year clock. I mean, to get the maximum benefits from them, you're going to need to have had that IRA open for 5 years. They come with a few strings, things like the earnings on them. You have to be over 59.5 and that 5-year clock. So otherwise you might be actually paying tax on it. You're allowed to use IRA money, Roth IRA, SEP IRA, traditional IRA to invest in real estate. You'll set up what's called a self-directed IRA. And now when you do that, here's the big thing you want to be careful of. IRAs, doesn't matter if it's Roth, SEP, simple, pre-tax, traditional, if it's got the letters IRA after it, and you're investing in real estate, you might have to pay tax on the earnings. That tax might be as high as 20% on the profits. So it's not just on the money. And the only reason that you're going to pay tax is because you made a profit. And the tax cash that you use, that you pay those taxes, comes out of the profits. So you're not really out of pocket. It just means that maybe the larger return you're looking at might just have like a little bit of a 20% haircut. Something just to remember. Not a bad thing, just something to remember. And many states, especially like Texas, IRAs, unlimited creditor protection. So it's a good way to protect your assets. It's a good way also, people that want to pass tax-free income onto their kids. So we talked about the death tax, but if done right, the Roth IRA, you might be able to pass it on, not just to your kids, to any heir. The heirs may be able to inherit it tax-free. So it's always a, free, not tax deferred, but tax-free.
And we talked a couple of weeks ago, I think we had also, and we had some people on from Quest as well, Bill, that went through these different, or the last one to tie into this as well. I'll actually go to the last one and then we'll come back to what I was going to talk about
Yeah.
with Quest and a custodian and those types of things that ties with the operational side of some of this. Go ahead.
Yep. And so exactly like Mike was saying, when I say self-directed, you still need to work with the custodian. There are still certain rules that you want to follow. You need somebody to keep your record keeping, need to do things properly, or you could blow the IRA up. And then we'll do the solo can of heck, something new this year for 2023. If any of you are already investing with your IRA into a passive deal, you're going to want to make sure and obtain your own employer identification number. So Quest is a custodian, Equity Trust custodians, Guardian, different ones. They're the custodians, and their tax ID number will be on your K1, and then you got your own Social Security number. You got to remember your IRA, for the purposes of the Internal Revenue Service, it's like its own corporation. It's its own person, and you may have to pay tax on that IRA. And when you do, that IRA will file its own tax return. Tax return is called a 990-T Tango, so a 990T. And when you do that, you're going to need a tax ID number. But in the meantime, you still need to get that tax ID number now to make sure that it's getting reported properly for your lead investors. Just a little thing there to do. It's free. Go to the IRS website. You can get them for free. The final one.
And I forgot. Hey, before you go, sorry, Bill.
Yep.
I'll jump in real quick and before we
No,
go.
please.
I forgot to plug in for the poll. I know Trevor talked about it earlier. I think they ran through one poll and I missed it. We're on to the second poll now, and but the polls help us as well. How can we be of more service, more help? The first one I think was looking as well to like what people were more interested in and learning more about. And then this is also learning more about you and how we can support and connect with people. So we really appreciate you guys take the time. It doesn't take long. There's just fill out the poll if you would. Get us, to if we can get up to 50% would be awesome. 75% would be beautiful. So Bill, go ahead, sir.
Yeah, thanks. So IRAs also, where they also overlap with the 401k, that's often what CPAs call like qualified dollars. That means that there's like a tax qualification. And so they're not what they call like the non-qualified, because they have a certain tax treatment. And the money that's in there can be invested. Now, to put new money into it, there's often limits. It's based on your age. So like IRAs, what is it, like $7,500 or something like that? Actually, I forget the exact number. You still have time to put into your 2023 IRA if you so choose. And so you have until April 15th to put that money in. Now, the limits for 2023, the IRAs, it's based on your age. So if you're under 50, 49 or less, you can put in up to $6,500. If you're over 50, add $1,000 to it. For 2024, that number jumps to 7,000 and then 8,000 for those that are 50. And 50 means you turn 50 during the year. 50 on January 1, 50 on December 31. If during that year you turned 50, so like if you were born in 1973 and you hit 50 last year, you're allowed to do the extra $1,000. But now not everybody can do a Roth directly because they come up with income limits, and the income limits are going to be based on if you're single or you're married. So if you're earning over 83,000 as a single or over 136,000 as married, you may not be able to do a Roth directly. Sometimes you do things that are called like backdoor Roths, which are allowed. It's a little more than we're going to get into here. Everybody can have a Roth, but not everybody can open a Roth just by putting money straight into it. Now, the solo 401k plan, they also call it like a uni-K, one-man K. That is basically, it's the exact same thing as a regular 401k plan if you ever worked for another company, they had one. Difference is you can have one participant, or in the case if you're married, both spouses can be into it. You have to own your own business. Now, the business could be self-employed, it could be LLC, it could be an Inc. But you do have to actually have a real business that makes money. And then what you're allowed to do is defer money from those profits or from your W-2. Again, in the case of if you've got a corporation, you're paying yourself a paycheck, you can defer those. You can do those as Roth. Nice thing with a 401k, there's no income limitations. You can put all you want into the Roth or into the pre-tax when you're inside of a 401k. Now, those limits, they still have some limits. It's based on the amount of income that you make. So if you're taking a W-2, 2023, you were allowed to put into 22,500 plus anywhere from 20 to 25% of your profit. And if you're 50 or over, you add another 7,500 on top of that. You could have done 30,000. 2024, that number jumps up to 23,000. So, and then plus, you add the 7,500, you're up to 30,500 plus company profits. It's a nice way to put it away. Biggest thing that comes advantage of a solo K. Now, remember, you have to qualify. This next thing I'm going to say sounds really good, and everybody's like, well, I want a solo K. I want a solo K. You have to have a real business to do it, not just I'm a gonna. Solo 401k plans, they can invest through real estate directly. They don't have to pay that 20% tax on the profit. They're not subject to UBIT. So you create like a Roth inside your 401k. You do pay tax on it once. It's much like, the Fram oil filters. Pay me now, pay me later. You do a pre-tax IRA, you're getting deduction now, but you're going to pay them later. You do the Roth, you pay the tax now, and you don't pay it again. You put that into the solo 401k plan, you could be setting up some serious tax-free money going forward into the future. Let me tell you how huge that is, or to me. Everybody, they understand tax. Most people understand tax, and most people think they're going to retire in a lower tax bracket. Very possible. Then I don't know, JFK, when he was president, he went crazy. He dropped taxes from 92% all the way down to 70%. So just imagine, if you're paying 70% of the top bracket. Reagan comes along and, the mid 80s, he drops the 70 down to 35. So we're looking at, relatively low taxes right now. Even 37 is still, among the lower. I'd love for it to be lower, but they may raise them again. Say you're at 20% tax, which is not bad. It's, still tax. And you need $10,000, $10,000 a week, $10,000 a month, $10,000 a year. Doesn't really matter. We're going to go with 10,000. Well, you're making money now, so you can probably budget now. Typically, when you're retired, you don't really want to have to work. You're just trying to draw down from your savings. And if you pull it out of a Roth, you only have to reduce your account by $10,000. But if you have pre-tax, you have to factor in the tax. That means you have to take out $12,500 to get $10,000. That's because even though like 20% of $10,000 you'd think is $2,000, make it $12,000, you got to pay tax on the tax. So you end up having to take 12.5, pay tax of 20% of the 12.5 to net 10. And so that's why sometimes Roth again becomes pretty huge. Now, again, filing the 401k, it comes with different tax returns. Their tax returns called the Form 5500, 5500. Third-party administrators set these up. We can help, set you up with people like that, but they're very good options for investing. But again, like with everything, it all kind of depends.
Go ahead. Well, Trevor, you could have just jumped in and shared
I
some
could have,
things
yeah,
as
but
well.
I saw you going, so. I did put in the chat there too. Bill's the only accountant that speaks English. I didn't mean that he doesn't speak a different language. I meant that he makes it simple to where you can understand it. And we do, so if you book a call with someone on the Massive Capital team, we can get you directed to where you could get a session with Bill. We're about to end the next poll, so if you want to be heard, go ahead and do it. And then we'll have one more to end the night before we get, and any Q&A, just raise your hand or put it in the chat. We're getting close to the end here.
Yeah. Now, I know a lot of people were talking about taxes of individuals, partnerships. So one of the questions about corporations, there's actually two types of corporations. One's called an S corporation, S like September. The other one's called like a C corporation, so C Charlie. The C corporation, it's like its own person. It'll report its own income. It pays its own tax. Currently, that tax rate is a flat 21%. So $1 or 100 million, they're paying a flat 21% at the IRS level. Individual states will often tax them at different levels, but at the IRS level, it's 21%. They work out really good if you're trying to defer a lot of cash for the future. Also work out really good for like foreign nationals. They own C corporations, tend to be better. Now, a U.S. resident paying taxes, not always the best way to own real estate because it's hard to get the cash out of the C corporation. It's often in what they call like a double taxation. S corporations are good. They just come with some strings. It's nice. The profits can pass through to the owners. Cash flow can pass through to the owners without getting taxed twice. You don't get hit with an income tax and then a dividend tax. But with an S corporation, they do have to take payroll. And so you are taking a paycheck on some of the profits. The other thing is there's oftentimes in real estate limitations on the losses, which means sometimes you may see these big depreciation deductions and you want to take them. But if you own your real estate through an S corporation, you might be limited as to what you're able to deduct. So before you start entering them, LLC is a great option because the day you form the LLC, you don't have to decide what it is. You can think about it for a little bit, have a good idea. Recommend talking with a good CPA, good tax preparer, good attorney. Like have a plan of what you're doing. And sometimes maybe it's just like, hey, I'm just kind of kicking the tire trying to figure out what I'm doing. And the other thing, y'all might have a really good CPA right now, one that's helping you. You don't have to use me. I'm happy to help you. I always like working with real estate clients, but it's one of those, like if you got some brother-in-law or something like that that's doing it, or if your CPA really talks to you really well and you've got a good attorney that's working well, keep your good people. I mean, I don't like losing clients when, if I've been doing them good service. So, I don't really necessarily want to take business away from somebody if they're helping out, doing a good job. But, if you need help, let us know.
Yeah. Hey,
Now,
Bill. So
yes.
yeah, I was going to jump in a little because, and I wanted the next part, and I'll let you fill in the blanks for me on, the W-9 and K-1s a bit, because obviously you understand it better. But I was thinking of it from our investor relations standpoint as well. Like so I'm just going to share a few things, like what we try to, and you can help me fill in the blanks, like ways to communicate to investors on expectations sometimes about K-1s and everything,
Yeah, perfect.
and the W-9. So for us, the K-1, it is, we're in the process of, we collect all of the investor data. So on the investor relations side, we will be collecting W-9s, we'll be collecting where do you live, everything related to that. Most of that's in that W-9 form, because that has a lot to do with the process that Bill follows to get him the data. So what happens is we prepare the list, we get a cost seg done, a cost segregation study on the asset done. And this is in the first year. And then we also provide a total year of financials. Basically, like typically we use QBO, QuickBooks Online. We give Bill access. We give him our investor data set, which is similar to, just here's all of the investors, the amounts invested, where they are, where they live, even a copy of the W-9s, and hand that over to Bill with or to the CPAs. In our case, it's always Bill that we hand it over to, and also with the cost segregation study to go forward, and then let Bill go through that process. So all of that has to be done on a deal, and there's the closing out of the previous year that you do on your financials before Bill can really even start the process on so it's not just K1s, but you're actually filing your taxes for the property. The filing of the tax for the property then gets cut out into K1s for all the members of the limited partners and the general partners. I'm going to turn it over there to you, Bill. Fill in the gaps, build it out, explain that process more and expectations, tying to get everything to March 15th deadlines.
So the W-9, again, that's on the front end. So as we're putting these deals together, or I'm sorry, as the lead investors are putting these together, they need to know who is involved. The information from the W-9 is going to go directly over to the K1. So we first have to make sure who it is. Now, sometimes people can kind of, give it verbally, they can do things, but it's like, we like to have those so people don't transpose the numbers. And the big thing that sometimes people miss on this is if you're an LLC, but you're disregarded, like one person owns it and you're not filing a separate tax return, then you'll actually check the box for the individual and you'll need to give your social security number, because the IRS is really saying, who's going to report this income? We understand you're an LLC, you're an LLC for tax purposes, but the K1 is going to get issued to both you as an individual and your LLC. Now, if you're a partnership, C corporation, or an LLC tax the partnership, C corporation, that's fine. We need the name of your LLC and then how you're taxed. We're also going to need to know your address. Address becomes very important. It's your legal address. You can have maybe a mailing address, but certain states have requirements. So as we are putting things into the K1 and reporting them, there's 8 states in the US that require, even if, say, the property is in Florida with a Florida LLC run by Florida companies, but somebody's in Indiana, well, we have to file an Indiana tax return because Indiana says, hey, if you've got one person in there from our state, we want you to file a return in our state. Pennsylvania, Oregon, New Jersey, New York, Georgia, West Virginia, Missouri. These are all the states that require these things. And also what happens in case the IRS ever has a question, they're like, hey, why'd you list this person's name with this tax ID number? This becomes kind of the document and proof. If you have an IRA, we're going to also need to get that tax ID number. It's very good when you fill things out, the tax ID number for Quest or Equity Trust, whoever you're using. And this year, that IRA itself is going to have its own unique employer identification number. Now, sometimes there's things that kind of come up. People mention trusts. Trust is kind of like saying the word car. I have a car. Well, do you have a Ferrari? Do you have a Hyundai? Do you got a Chevy? And so not all trusts are the same. Generally speaking, I've seen in real estate, people use what's called like a living trust or a revocable trust, which really give you no asset protection, but do a great job for estate planning. They're able to help consolidate all the properties or investments under one name. So if something happens to you, the name continues, but the person underneath the name gets to change out, who gets to inherit that. Works great. Now, an LLC or an LP would do the exact same thing and give asset protection. Revocable trusts and living trusts, they don't file their own tax return. They just fall back to on the person's social security number of whoever filed it. Other ones, as we start getting into complex trusts, grantor trusts, certain maybe trusts irrevocable. Irrevocable means that if you put money in, it's like the Roach Motel. Once you check in, it doesn't check out. And so those type trusts that pay their own taxes, they will have their own unique tax ID number, and they have to file their own separate tax return. But basically, if the trust is not filing its own tax return, it's probably going to fall back on the social security number of the individual. So all the stuff that's due up front for, hey, we need to make sure we identify who you are so that we can prepare our tax return correctly, which moves us on to the K1. Most of the real estate investments are going to be carried on through what's taxed as a partnership. Most of them will be an LLC, not all, but most of them. And in this case, an LLC, it's really not much more different than a spaghetti colander. So you can pour hot water in the colander, you can pour cold water in the colander. It doesn't hold any of the water. It just all flows out. Now, how much flows out to you is based on how much you own. 1%, 2%. Say you own 10% of the company and the company creates a $100,000 loss for tax purposes. They're going to pour the $100,000 of loss into the spaghetti colander, and you're going to pick up $10,000 of it. That's going to come out to you. Well, they need something to tell you, hey, here's your share of the losses. That's what they give you, and that's the K1. Typically up there in box number 2, where it says net rental real estate income or loss, that's where it's going to show minus 10,000. Same thing would happen, say it was 100,000 profit and you own 10,000. They distribute that out to you, the income, and they're going to report to the government. When I say they, I mean the LLC, the deal itself. Say your share was $10,000 of profit. Now, over in box 19 is where you're going to see the cash flow. That's the box that says, here's how much cash you received this year. Now, cash flow is not the same thing as income, typically because we can take a lot of deductions through depreciation early on. So we get to front load a lot of our losses early. And then as we start paying the cash flow later, we're really just like, hey, I already lost all this money. I'm probably not going to need to pay any tax until I recover all my losses. Other important things, mostly, what's important for you when you receive your K1, you're kind of like, hey, what should I be looking for? Well, if it's the first year, you're going to want to look down there in box L and where it says capital contributed for the year. And the second line down is going to say how much money you put into the deal. That's going to say, okay, I want to make sure that I matched how much money I put into the deal. Now, also up at the top, so in E and F, kind of like, say 10 o'clock on the clock as it goes. That's where it's going to make sure, did they get the right tax ID number for you, social security number? Did they get the right name? Do they have the correct address? That's who you are. Down in box J is going to be how much of the deal do you own? So those are just kind of more informational things, but it's very possible that early on you're getting a loss. It just kind of remember that. That's because what we're doing is we're taking deductions up front, usually through cost segregation. A good way to think about it that way is, say you had a really big log and you wanted to put it on a fire. Say the log's like 24 inches thick. You can throw it on the fire and it'll steadily burn. And imagine it were to burn for 27 hours. Okay, that's great. It's a nice, even burn. Or you can start chopping up a bunch of pieces in it, turn them into little pieces of wood, throw those in the fire, and they're going to burn a lot faster. They may burn up in the first hour or two. It's still the same log. You haven't created more log. You just were able to burn off a lot of the pieces early on. And then there's still, say, half the log that will continue to burn for 27 hours. That's what cost segregation does. It basically breaks it into smaller pieces, allowing you to burn off things a lot faster. Now, the nice thing is the real estate, though, if you don't need them, or say you're a passive investor, they're not gone. You just get to store those losses. You get to bank those losses away for the future, holding those losses behind glass, and the glass just says break in case of profit. So it's a very good idea. You want to always save all your K1s from the deals, because if you ever go back, from the day you start until 3 years after the deal is closed, save all of your K1s, because if you want to go back and rebuild the total of all your income and losses since the beginning, these you'll want to save, even if it's 20, 30 years. Most deals 5 years into it, they're closing, they're gone. But you just want to make sure you keep your K1s there, just for tax purposes, not only this year, but every year. March 15 is when the first deadline for the partnerships exists. And it's possible that the partnership itself can file an extension, giving it until September 15th. So we try to get the partnerships out. We try to complete everything by March 15, but sometimes for certain reasons, they may not get they may not get out to everybody on time. Could have done a 1031 exchange, could be waiting on the cost segregation reports, could be various reasons, waiting on people. Again, they didn't fill out their W-9 correctly. So now we need to get the W-9s filled out correctly so we can do the proper tax return.
Oh, go ahead. Go ahead, Trevor, please.
We did have a
Mike.
question earlier about UBIT and UDFI, our favorite things that
Yep.
Nobody quite seems to ever understand.
So, short version, the IRS says, hey, if you're investing with an IRA, you have an unfair advantage over those that are investing with their own money. Because if you make a profit, you don't get to pay tax until you decide later to take the money out. And somebody has put their own capital in, when they make a profit, they may have to pay tax right now. I don't think it's a bad thing. Hey, it's great, it's an IRA, but the IRS decided it was a bad thing. So they started taxing people on their profits. Well, it did come back of like, wait a minute, I'm a passive investor. You're trying to say things like, what if my stocks went up in value? Am I have to pay tax on that? Or if I'm buying and selling stocks, bonds, mutual funds, those weren't necessarily profits based on the fruits of my own labor. So the IRS says, yes, correct. For the cash portions of your IRA, when you invest, now 401k, this doesn't count. It's only IRA. And I understand Roth IRA, you're supposed to get those tax free. If you get something with the letters IRA in it, the next things all apply to you. If your IRA invests in an all cash deal, you don't have to worry about the extra tax. It's all cash. Now, if your IRA invests in a deal that carries a mortgage, now the mortgage actually, if you look back on your K1 down there in section K, where it talks about your share of the debt, that typically shows up like when you have the mortgage. But so if you have a mortgage, and when I say you, if the deal is carrying a mortgage, and then if the deal generates a profit, to the extent that profit was generated by the mortgage, i.e. borrowed money, that is considered unrelated debt financed income. And so the IRS is going to say, hey, we're not going to tax you on your cash portion, but we are going to hit you for tax on the profits you earned from your borrowed money. And that tax rate is at the UBIT rate, unrelated business income tax, which is equal to the maximum long-term capital gains rate. Currently, that number is 20%. So if you look up IRA passive investments, and these are all passive, I guarantee if you were to do a Google search, you'll find out IRAs don't owe tax on passive investments. That is correct. You just got to go a little bit further and look up UDFI, unrelated debt financed income. And so the profits on unrelated debt financed income, they call those UBTI, unrelated business taxable income, that pays a tax rate of UBIT, unrelated business income tax. I realize all of these are about as much fun as a UTI, but I don't make the rules. I just got to help you figure them out. So you pay tax when your earnings exceed $1,000. So if your IRA makes a profit of $500, you're not having to worry about it. But just remember, you might have IRAs in different deals, and each deal gets to do its own thing. You don't get to use the losses from one to offset the other. So if one of them has a profit of more than $1,000, you're having to file the form 990T to pay the tax on those profits. And remember, the only reason you're paying tax on the profits is because you have more cash. So typically what will happen is, if usually like it happens in the year of the sale, the money goes from the lead back to Quest. The custodian is holding your cash. We file the tax return, we show the balance due on the tax, and then Quest will send the money on to the IRS to pay your taxes. The reason 401k plans don't pay it, solo K plans, unit K plans, they're specifically exempt from the UDFI requirements. Why exactly? I don't know. You know, I guess they had a better lobby that went to Congress and got them to pass that law, where IRA people didn't have as good of a job.
Hey, I don't know if Srini, I think you may have gotten your question answered, but Srini was, I think, asking about where the depreciation goes.
Yep. So
and I think you answered it, but we can just make sure
yeah, so at the end of the day,
I think, and do you mean where does it go on the K1, or where does it go in your when you file your tax? I guess that probably clarify those two, Bill.
Yep. Here, let's make sure I get your question correct so I can answer it correctly.
Srini, you want to go ahead?
Do you cover that depreciation in K1 or is part of the whole of the deal?
Okay.
Where do you cover?
Okay, so what happens what the IRS is going to do, they're going to say income minus expense. Not the same thing as cash in minus cash out. One of those expenses is depreciation. And so inside of the K1, up in box number 2, that's going to be your share. Again, like remember the spaghetti colander, if you own 10%. So 10% of the bottom line. So if we take income minus expenses, whatever that number works out to be, that's what gets reported in your K1. Depreciation is what they call a non-cash expense. And so we're going to take a deduction even if we're not paying cash for it. So if somebody has a mortgage or somebody pays cash for a property, they get the same depreciation deduction. Depreciation is how we recover the cost of the building, not the land, but the building. And there's different methods to record depreciation. In residential property, you could divide it over 27 years, or you might do the cost segregation study, which kind of breaks it down into different components, and you might write off a third of your property in the first year. So imagine two properties side by side. One of them says, we're going to divide it by 27 years. The other one says, I'm going to take 33% of it and write it all off this year. Exact same properties, say the same number of doors. They all have the same operating expenses, but the one that took the faster depreciation in the first year will show a bigger loss. Now, that loss will be factored. It'll be a piece that'll be buried inside of that box number 2. If you are in a state that does not allow the bonus depreciation, your K1, a couple of pages back, will have a couple of disclosures that says, here is your share of bonus depreciation, and then here is the straight line depreciation. Because we have to disclose for those people that maybe are not allowed, because while the IRS allows bonus depreciation, not all states allow depreciation. In Texas, people are like, what are you talking about? There's no state income tax. Right. There's 49 other states plus, Washington, D.C. So with the exception of like Florida, Tennessee, Nevada, South Dakota, Washington, New Hampshire, some states have to pay the tax. So we end up disclosing that, going, hey, for those of you in other states that don't allow bonus, here's your information. But typically the depreciation as an expense, it's baked into that loss number up in number 2.
That's awesome. Thank you, Bill.